Hi, Abraham. Now, it's been a really challenging year on the financial markets, so I thought we'd take a closer look at what's been going on and what investors need to focus on. Can you remember a year quite like this one? I certainly can't.
Well, you remind me of the famous old saying, Robin, the four most dangerous words in investing this time is different. The thing I love about investing is that each year has its own unique, challenges. But if you look closely enough, you can see a lot of parallels to a different time. So I'm very hesitant to say that this year is completely different or unprecedented because, as we'll see, it's not.
Now, I know that Timeline keeps a very close eye on how different asset classes and different portfolios perform year after year. What does your data tell you about the falls in the stock and bond markets we've seen in 2022? And how unusual is it for stocks and bonds to fall at the same time?
Very good question, Robin. So, what we did is essentially to look at 120 years of capital market data between, January of 1900 and December of 2021. So we've excluded, the current year. And what we did is to run rolling 12-month periods, between that, which gives us something like 1,300 different scenarios. And what you'll find when you look at this data, Robin, is that UK bonds, if we just look at UK bonds, you end up with a negative return in one out of every four scenarios. So, that's before you factor in inflation. Once you do factor in inflation, the real return on bonds is actually negative once every 3 years. Now, these are sort of 12-month rolling period rather than calendar year. Um, and then when you look at, periods or scenarios where both equities and bonds are negative, again, you get that about one in every 10 scenarios before you factor in inflation. Once you do factor in inflation, you do get a negative return for both equities and bonds in about one in every five scenarios. So, whilst these are challenging times for investors, these type of scenarios are hardly unprecedented.
So, Abraham, our guest on this episode is Joe Wiggins, an expert in behavioural finance. I started by asking Joe for his view on why 2022 has been so tough.
The environment for investors in 2022 has been incredibly challenging, particularly for cautious investors, because the types of diversification which has worked for 10, 20, 30 years between equities and bonds has broken down for a temporary period. So losses in equities and also losses in bond markets, particularly longer duration bonds. Does that mean that diversification is permanently broken? No, it just means there'll be times in unpredictable, challenging markets when different things happen, when things that we've experienced previously don't come to pass. So it doesn't refute the idea of diversification. It just means we need to be able to withstand difficult, unexpected periods. We're still investing in equities and bonds for the right reasons, for the coupons and for the dividends that they generate. That hasn't changed. It's just over the short term, sometimes relationships break and behaviours of financial instruments is different.
The financial industry loves complexity, and the impression it often gives is that challenging times call for complex investment strategies. For Joe Wiggins, that's completely wrong. Most people, he says, should be keeping it simple.
There's a real danger when traditional strategies are struggling. So if we think about a 60-40 simple portfolio as struggling through the environment in 2022, there's a danger that they're tempted into investing in more complex strategies. So maybe hedge funds, maybe private equity, because of the allure of generating different or distinct returns. Generally speaking, that's, I think, a dangerous path to go down. One critical rule for all investors is never invest in something you don't understand. So particularly investing in complex hedge fund strategies is a way to navigate these markets. And that's problematic for two reasons. One is they haven't delivered for a significant period of time, even through very favourable market conditions. So to believe that they will now is, I think, dubious. And also, I think it's incredibly dangerous just to invest. If you can't simply explain in investment strategy how it works, how it delivers returns, I think you should be very cautious and careful about investing in it.
As we've heard, both shares and bonds have fallen in value in 2022. You might be tempted then to consider a different asset class as a diversifier, private equity, for example. But Joe urges caution.
There's lots of talk in markets about the illiquidity premium for investing in things like private equity when you can't trade and when the underlying assets are marked to model rather than a market price. I don't think that really exists. I think what exists is a behavioural premium because you can't trade and because there's no volatility or less volatility in the price of the assets. You're less likely to make behavioural mistakes. But I think the problem I see in areas like private equity is that they've been sold as diversifying strategies, which in many cases makes no sense whatsoever because a typical private equity buyout fund will be investing in small and medium-sized companies, very similar to public equities. So it's absurd to think they're genuinely diversifying compared to a public market fund or strategy. It's just they're priced in a different way. So you have this illusion of low volatility, illusion of diversification, but they're still subject to the same economic environment as public markets.
So what about long-term bonds? They're supposed to provide a hedge against falling share markets, but clearly that hasn't happened this time. And some experts are suggesting that you sell out of long-term bonds altogether. But Joe says that would be a mistake.
The danger of what we've seen in 2022 with bonds is that we learn the wrong lessons. I think the wrong lesson to learn is that bonds are not an effective diversifier. They're a very risky investment. That's the wrong lesson. The right lesson to learn is that all investments, no matter what style, go through difficult periods and markets are inherently unpredictable. That means we need to be diversified and we need to be prudent in the decisions that we make. The other point to make is that we should think about future returns rather than necessarily what's happened in the past. So bond yields being higher now, significantly higher now than they were a year ago or 18 months ago, is a positive to investors who are investing in cautious portfolios now when their expected returns over the long run should be significantly higher.
What's happened in the financial markets this year is extremely rare. Market watchers call it a black swan event. My final question for Joe Wiggins is this. What can investors learn from the pain they've experienced in 2022?
When we have extreme market conditions or particular events that have profound implications for markets, like 2008 with the financial crisis, 2011 with the crisis in European periphery, in 2020 with COVID, we tend to base our decisions and our assessment of risk on the things we've recently experienced. So after 2008 it was about the banks and about financial crisis in the future, for example, and now I guess we're thinking about future pandemics and the implications of those, even if it's a very low probability event. So what we should be thinking about is there are risks ahead of us that will come to pass that we're not even thinking about now. So there'll be something that happens in the future years that we're not considering or thinking about now that has an implication for markets. That's why we need to be diversified. That's why we need to have sensible investment principles to guide us through those unexpected unknowns in the future.
So, Abraham, some very helpful observations from Joe Wiggins there. He clearly advocates keeping things simple amid all this uncertainty. Why do you think that's so important?
Well, two things, Robin. Investors are likely to be looking for anything to give them a sense of comfort and stability during periods of high uncertainty. They're likely to look to their financial advisor or their investment manager for some sort of comfort and stability. And then secondly, in times like this, investment managers in particular are likely to be under a lot of pressure just to justify their existence. So when you add those two things together, the temptation to add something complex to your portfolio, something that you don't understand, either as an alternative or a complement for the traditional equities and bonds, it is very high. So investors have to resist this temptation just to do something, to comfort ourselves in periods of uncertainty. Remember the words of the legendary Jack Bogle: don't just do something, stand there.
Of course, the problem at times like these is that investors' money has to go somewhere. Both shares and bonds have taken a hit, so it's perhaps not surprising that investors are looking to other asset classes, private equity, for instance. What are your thoughts on that?
Well, one way to resist this temptation is to actually reframe this decline in share prices or stock prices, and think of it as a sale. Someone says, um, uh, investing is the only business I know that when things go on sale, people run out of the store. So if you think of the decline that we're seeing in equity prices as the great companies of the world being on a sale, well, the worst thing you can do is to walk out of the door. It's actually a good time, to invest, as long as, provided that you're investing for the longer term.
Joe talks about the need to keep calm and carry on, if you like. Can you just remind investors why staying put when markets are volatile really is the best approach, and what timelines data tell us?
Well, I looked at this data again recently, just using an example of a balanced portfolio. So a portfolio with 50% global equity and 50% global bond. And what you find is that if you look at your portfolio balance on a monthly basis, you see red about one every three times. If you zone out a little bit and you only view the portfolio once every year, you only see a negative return. This is annual return. You only see a negative return about once, every six times. And then if you only look at your portfolio balance once in 5 years, you hardly see a negative return over any 5 year period. The point I'm trying to make is that for most people, the best strategy to manage volatility, now, provided that you invested correctly in lines with your goals and your risk profile, the best strategy for managing volatility is not to look at your portfolio so often. I know that's very difficult for many people, but it's a pretty effective strategy.
One final question, Abraham. It's one thing saying investors should stay disciplined, and another thing actually doing it. Joe tells me even he has to remind himself sometimes to stay rational. I'm wondering, how have you coped with the uncertainty yourself this year? And are there any tips that you can pass on?
For me, internalizing the long-term history of the capital market is the best antidote I've found against misbehaving, during market uncertainty. I have to admit to you, I pay very little attention to what's actually going on in the market today. I am more of a student of, financial history, and hence, the data and all the work that we do at Timeline. And I have to remind myself, we have a chart to visualize, how different asset classes have performed over the last 120 years and the different events, the major global events during that period. And what you find is that in the last 120 years or so, we've had the Great Depression, two full-blown out world wars, plus a lot of smaller ones, double-digit inflation, the IMF bailing out, the UK from an economic crisis of its own making, and not talking about just the recent one, the great financial crisis, a global pandemic. Yet, in that time, a global equity index has returned over 12% a year on average. So the point is internalizing this message, and this power of globally diversified equity investing, for me, is very useful when things do get pretty tough. So, you've heard our opinions. What did you make of our latest interview? Please send us your views. Until next time, goodbye.